Okay, so in this video, I'm going to talk a little bit about whole life insurance policies. For a whole life insurance policy, there are a few different ways that the policy can be purchased. One would be through the ordinary policy approach, which would involve stable premiums until a specified age. So in that case, the purchaser of the policy pays the same amount periodically until the specified age is reached. And at that point, the policy is considered fully paid and no more premiums are required for the policy. Another approach for a whole life insurance policy is a modified whole life policy. And in this case, the premiums are lower initially, but then they increase later. So obviously a concern there from a personal financial planning perspective would be if you purchased a modified whole life policy with low payments now, would you be able to continue making payments when the payments are increased later? You can also have whole life insurance policies that are maybe purchased on a single premium basis. So you pay one payment up front, and then the policy is completely paid in full. And in some cases, that may be particularly helpful for estate planning purposes or something of that nature. Now, in the case of a whole life insurance policy, it will build cash value over time. And so that cash value can be used as collateral for a loan. So you could borrow money with that cash value of the whole life insurance policy as the collateral for that loan. But with that in mind, there is a risk associated with that. And the risk associated with that is when you have borrowed against the cash value or borrowed using that cash value as the collateral, then in effect, what happens is if you die before, or if the insured person dies before the loan has been repaid, then what will occur is the payout will be lower at death by the amount of the loan. So the risk there is if the insured person borrows with the whole life insurance or the cash value of the whole life insurance policy as the collateral, in effect, what they have done is reduced the cash payout at death and therefore reduced the benefit that would be available to beneficiaries. So there's definitely a risk there that could end badly, and that inadequate insurance may exist in the event of the death of the insured person. Now, there is sort of a flavor of whole life insurance, and that is a variable whole life policy. In this case, the cash value of the whole life policy is actually invested. And so potentially what happens there is that you could wind up with more cash value because of the investment aspect. But one significant result of that is you don't actually know what the payment upon the death of the insured individual would be. And so this has made this somewhat less predictable. So the result of that is that it's a little uncertain what the payout will actually be, which could make planning difficult for the insured individual when they're planning for their estate and their beneficiaries and so forth. Which brings up some additional interesting ways that whole life policies can be used, and those are second to die policies and first to die policies. So for a second to die policy, this can be useful for estate planning. And basically what happens in this case is you have a couple that are insured with the second to die whole life insurance. And basically what happens for that is that when the first person of the couple passes away, then the policy does not pay out. The policy pays out upon the death of the second listed individual. And so that means that when the second listed individual has passed away, there is a payout which could then be used by the estate for estate planning purposes and things like that. So to perhaps provide liquidity for the estate and so forth. The logic behind that being that if there's sufficient assets to take care of both individuals associated with the policy, when the first individual passes away, they don't need a payout at that point. And so when the second one passes away, then that triggers the policy, which then perhaps provides liquidity for the estate or something like that. On the other hand, you could have a first to die policy. So a first to die policy would be one in which you have two individuals listed and the policy pays out upon the death of the first one, whoever dies first. And so in that case, this is more of a situation in which perhaps there aren't adequate resources available to take care of the surviving spouse just without insurance. And so with a first to die policy, whichever spouse dies first, the surviving spouse receives a cash payout, which would then help to provide funds that would be needed for the surviving spouse. Okay, now with whole life insurance policies, one of the things that can occur is the purchaser of the policy can wind up with policy dividends. And so if there are policy dividends associated with that, basically kind of what's happening is a situation in which for the insurance company, the money that was taken in is essentially larger than what was necessary relative to operating costs, payouts, actuarial expectations, and so forth. And so basically what's happening there is a policy dividend is really a partial return of the premiums that were paid. And so for those partial returns of the premiums that were paid, there are a few different things that could be used for those policy dividends. So one thing that can be done is cash. So you could if you have a whole life insurance policy and you get a policy dividend, then you've got cash. That's good. Or that policy dividend could be used to reduce the premium, so kind of reduce subsequent payments. So that's a possibility. It could, in some cases, be allowed to accumulate at interest. So that policy dividend could then sort of grow and provide an additional benefit there through growth with interest. Also, those policy dividends could possibly use to purchase a paid up additional death benefit. In other words, the amount of the policy dividend could be used to essentially pay the premium for a one-time payment policy of additional benefit. So you get additional death benefit by buying sort of an additional policy or an additional increased amount of insurance. Or the policy dividends that you receive could be used to purchase a one-year term insurance to increase your insurance. So key things to think about for policy dividends, number one, is basically a policy dividend just means that the amount of premium paid was higher than what was essentially necessary given the actuarial costs and operating costs and things like that, the insurance company. And so they have returned some of those premiums. So it's considered a partial return of premiums. And then what is done with it depends on the choices that the insured individual makes. And there are a few different things that can be done with that. Okay. So a few other little points here. One of the things that I have already alluded to, but I want to go back to it again because it's important enough that it bears repeating. And that is that if you have a situation in which a policy is going to pay out after death, right? So the policy comes into effect, the insured person has passed away with a whole life insurance policy. The value is exempt from federal income tax. And so you get a cash payout that is exempt from federal income tax, which could provide liquidity for the estate, et cetera. But if you think about what happens if a loan was taken out with the policy as collateral, then what's going to happen is the amount of payout is going to be reduced by the amount of the loan. And that means that the tax-free payout is now reduced at death. And so now there is less of a tax-free payout, which if this whole life policy was being used to provide liquidity to the estate to ensure that it could pay other estate taxes or perhaps to enable the estate to continue functioning. Maybe it was a ranch or something like that, and they needed cash flow to keep the ranch running while the estate is sorted out. Well, if a loan was taken out, then there's now less of a payout. That's just period, and also there's less money that you're getting federal income tax free. And so if you have a loan, basically then that creates sort of a lost opportunity to get a tax-free payout to the estate. So that's something that is important to consider. Also, if a policy is canceled early on, so if a person with a whole life policy has built up some cash value, that cash value does belong to the owner of the policy. And so if the person chooses to surrender the policy early, typically and receive therefore the cash value, typically there will be surrender charges that will have to be paid for canceling the policy early. So that would need to be considered when determining whether it makes sense to cancel the policy early or not. Okay, which brings up the final point, and that is basically there are some what are called non-forfeiture protections for that cash value. So that cash value is considered to be owned by the owner of the policy. It's built up over time for the whole life policy. It's owned by the owner of the policy. So there are some protections for that. So and some kind of protections for how it is ultimately paid out. So basically what that means is there is there can be like a cash surrender value, right? So if the policy is surrendered early, then it's paid out. There may be surrender charges, but it is paid out. And so there are regulations requiring that be done in a particular manner, so that or protections to make sure it's done in a particular manner. If there's a situation in which a person is no longer able to make premium payments, sometimes what can be done is the cash value that has been built up in a policy could, for instance, be used to pay for a reduced but already paid up insurance policy. So in that case, sort of kind of converting from an ongoing premium payment scenario to taking that cash value and applying it to just pay for a completely paid up whole life insurance policy. Or perhaps it could be used to pay for an extended term insurance. Ultimately, just there's some ways that cash value can be used, and it is considered to be the property of the owner of the policy, but it can be applied in a few different ways. All right, hopefully this video on whole life insurance has been helpful, and I will probably be posting more videos here soon, and I hope they benefit you. Have a great day. Thanks for watching.